Hey, what's up, everybody? It's Monday, September 19th. I hope you had a nice weekend. So, today the market to me, it looks like a market that just is very oversold. And that's kind of like a technical term by oversold. I just mean like the market looks to me like a market that's really, really short. All right? I think I described to you guys, some of my experiences in the past as a floor trader. I was a member of 4 different exchanges, and I traded S&Ps on the Chicago Mercantile Exchange. I traded the NYMEX in New York, the COMEX, the New York Futures Exchange. But I remember vividly, like, there were times when, the pit was short. And that was us, like the independent traders, the locals, we were called. We just, for some reason, loved selling the market. No matter what market I ever traded in, for some reason, it just seemed like, the locals, the independent traders, they just always wanted to sell, regardless of what commodity or contract it was. But anyway, there were times I could remember that we would press the market and press the market and press the market, and we're all short. So, like, in order to make any money, we got to cover those shorts, and our buying, it starts with one guy or 2 guys, and then it just, it's kind of like a snowball effect, and it just pops right back up. And today, the market reminded me of this. I mean, they tried to take it down again to Friday's lows. They tried twice. They tried overnight, and then they tried again this morning, and then we rallied and we closed higher. The other thing I want to mention, or actually the other thing that I want to remind you guys, because I did say this last week, is it looks to me, and this may still be too early of a call because I want to get into the fiscal flows in a minute, but it looks to me like the decline that we have experienced since the Powell speech in Jackson Hole back in August to the bottom of this move, whether you measured it today at the low point or Friday, that's the same magnitude as the decline we saw in June from the last time we had the quarterly corporate tax payment. And I've been telling you guys that the tax payment was coming. I said it all the way back in June. I said we're going to have a positive period into August, and then the tax payment is coming, and then we're going to get a volatility. We're going to get a sell-off, and that's exactly what happened. But now I want to talk about these flows because, Friday was another net drain of, I think it was like 17 billion. So far for the month of September, you ready for this? We have had a 133 billion net drain. That means 133, and most of that, I have to say, came in the last 6 business days, from September 8th until September 16th. 132 billion sucked out of the financial balance, reducing the financial balances of the economy by 132 billion in a matter of days. It shouldn't be a surprise to anyone when you understand it for what it is. And that's, I'm stating it exactly as what has occurred, to drain that much. And you may be feeling it personally. I know I am with corporate tax payments. Your account goes down, your balances go down, and it takes time to rebuild those things. Whether it's through your own, your wages, your salary, your business income, whatever, it takes time. So this is exactly what has happened. I could say that, right now, basically, the thing that is killing the economy, the thing that is killing the recovery, is this high level of taxation. And I'm going to talk about that in a second. To me, it's like, if you want to paint a metaphor, it's like, a fighter in the ring, who keeps getting knocked down, and every time he stands up, it's like, boom, again, knock him down because we got these tax payments. Now, a friend of mine who's an accountant, he said, Mike, what are you talking about with you know, these tax drain? I mean, taxes haven't been raised. They're the same as they were. And I say, that's correct. But you have to understand how fiscal is structured, okay? We are paying taxes on earnings from last year, or in the case of, you know, corporations, let's say the last quarter, or it's basically from last year, okay? Last year, that was a record amount. I mean, we were growing at 7, 8, 10% in GDP. It was a record amount of stimulus. They were still sending out checks. So, I mean, what happens is that right now, we're paying taxes on income and transfers that were made last year, that transferred to our you know, our income, our wages, our salaries, our balances. But this year, the leading flow is spending. Spending comes first and then taxation, right? You have to understand that. Like, most people think it's taxation and then the government spends. No. The spending comes first, the dollars go out into the economy, people earn the dollars, and depending on what you earn, you know, there's some tax liability that you have to pay. So here's the problem. Spending has slowed down dramatically. What are we like? We're like almost $1 trillion less in leading, I think it was something like 900 billion. 900 billion less in leading spending flows this year compared to last year, okay? So the spending has gone down, but we're paying taxes on last year when the spending was almost $1 trillion higher and the economy was growing much faster and profits were much higher, etc. That's what the problem is. See, we're on an economic contraction. It actually works in the opposite fashion. That's why we call it an automatic stabilizer, right? When the economy goes into recession and stays in recession, what happens? You get people who are laid off, unemployment benefits, which are automatic, they start going out. People, you know, maybe claim Social Security or go on Medicare, Medicaid, disability things. There's a safety net there. So what happens is that taxes drop in that instance because profits are down, wages are down, salaries are down, people lose their income. So taxes go down. The government can't collect as much taxes, but at the same time, the automatic stabilizers, unemployment benefits, all those things start to increase. So then we have the opposite effect where the automatic stabilizers cause spending to advance, accelerate faster than taxes. Taxes are actually shrinking. Tax deposits are shrinking in that case because the economy is contracting. So we got this kind of a system where, you know, when it's bad, when we hit the skids and it's bad, and it, you know, then luckily things kick in to stabilize it. All right. But on the other hand, when it's good, like it was last year, you know, then we get to a point where taxes start to advance, or taxes start to accrue, or the tax deposits start to come in faster than the spending. And it's been kind of exacerbated this year because spending definitely has been cut, right? We don't have those unemployment benefits, the supplemental unemployment benefits, no checks going out, no child tax credits, none of those things that we had last year. Now, there are some things that when I look at it, you know, they look promising, but it's going to take a little time. You know, like there's these income interest transfers, interest income transfers. Like I did a whole basically video on this the other day. I was like, everybody's freaking out over interest rates, oh my God, interest rates. But like right now, if you just look at the discount on T-bills alone, the discount is effectively the interest rate that the government pays, right? A T-bill, it doesn't have a coupon, it doesn't have an interest rate attached, but it's sold at a discount, and that difference between its face value and the discount, that's basically its interest rate. It's already added $37 billion in interest income this year compared to last year. Last year, it was like a nothing really. I think it was like, at this point last year, the total discount amount paid by the government was $1.8 billion. Right now it's like $40 billion. So, I mean, that's really starting to kick in. And interest on Treasury securities, that's kicking in too. But as I've said in the past, we have to wait because you got maturities out there. You got securities that still need to mature. And then when the new ones are issued to replace the ones that are maturing, they're going to carry the higher coupon. So we're going to have an elevated level. A lot of people don't realize that, if you're old enough like me to remember, or if you just, are interested in this stuff, like Reagan, the Reagan boom, Ronald Reagan. Everybody thought it was because of defense spending, but if you go back and you look, which I did, like the largest component of GDP and the one that had the biggest impact was interest income. I mean, that blew everything else away because Volcker jacked up the interest rates to 20%. So the interest income transfers were humongous under Reagan. Now, nobody said it at the time, but, that's what it was all about. And we had a boom. The stock market went crazy. It went straight up. That was people actually, economists and historians actually mark, like 1982 as the beginning of the great bull market. I mean, which basically we're still in, if you want to, or you could say we were in until recently, but, and we're still in, but that was like the beginning. I remember I was just really getting started out on Wall Street at that time. And I mean, it was a wild time because we were emerging from, the 70s, which saw a lot of inflation and rate increases. But those rate increases ended up, that was the rocket fuel that fueled the boom. I mean, that was it. There were some other things too, but that was it. In terms of fiscal, man, that was the thing, and nobody really understands that. And we're gonna have the same thing again now. When this stuff really starts to kick in, but right now, of course, the jitters, and it's not even jitters, that's too kind of a word. The psychosis, the delusion over monetary policy and rates. Like I want to, use the correct terms here because that's seriously what it is. It's a psychosis, it's a sickness, it's a mental illness, it's a delusion. That is what is driving everything. And really, these are minor moves, these corrections that we've seen. I mean, in the big picture. I mean, if you really step back and if you look at, where we've come and what has happened, and by the way, what has happened is really a function or a result of what I just said, the cuts in spending. I mean, we took out $1 trillion in leading flows. I've said this before, it's like we were going at 200 miles an hour. If you think of a car going at 200 miles an hour and slamming on the brakes, that's what happened at the beginning of the year. And now we're just kind of stabilizing at a slower level, whatever, that it's like 60 miles an hour. Instead of going 200 miles an hour, we're going 55. And we got to get used to going 55, but we're not going in reverse. We went in reverse. I mean, we didn't even we slammed on the brakes to the point when we went in reverse for the first 2 quarters, but I'm pretty sure that we're going to see a positive third quarter and a positive fourth quarter. And so that's the thing. That's the thing. So, when you suck 132 billion out in a couple of days, I don't think you got to be a genius to understand that has an impact. I mean, think of it in terms of your own financial position. I mean, when you got to pay taxes, that's a hit. And you feel it. And it takes time to recover. I mean, you need to see those balances rebuild in your account to the point where you feel, okay, I'm back to where I should be. And that's exactly what is going on, and that is the explanation. So long story short, I mean, today's market, to me, it seemed like an oversold market. The pit, we're short, and everybody, was looking around, and somebody, started to buy back, and it was like lighting a fuse on a firecracker. We went up. Small firecracker. But I wouldn't read much into this. In other words, I kind of would stay on the defensive until I start to see positive fiscal flows again. We need to see those positive flows come back into the picture. And I'm going to guide you through this. I gave you a date. I said October 6th. That's a date when we should be sounding the all clear. But just like I did back in May and June, I'll be telling you each day, okay, we just recovered 20 billion, or we just recovered 40 billion, or we just recovered, we're 100 billion, almost all of it. Like, I can see it every day. I mean, you see it in the daily treasury statement, the number. So it doesn't worry me. I would only say what worries me is kind of like a policy mentality that, hey, this is a good thing. Look at all the taxes the government is collecting. They're going to brag about it politically because the mass of the citizenry, they don't understand. They think like, oh, the government's got to balance its, got to balance its checkbook like everybody else. It's not like that. If it there's only one way it could balance its checkbook. That's taking the money from us, just like this drain did. The government this month went from a 92 billion deficit. It's in surplus of 33 billion right now. Does that feel good? I'm asking you, does that feel good? No, because it drained out what we have. It doesn't have to save its own money. It's the monopolist of its own money. People got to try to understand that, but we need leaders who can explain that to people. They don't. They're cheering that, hey, we're draining out everybody. Gee, I wonder how come the economy is shit. That's why it's shit. All right, everybody. See you tomorrow. Bye.